Welcome back. You are watching Wealth Manager. A trend that's on the rise is HNI lending to the real estate sector. What are the risks of such investments and what are the precautions you should take? With me in the studio is Feroze Azeez, Deputy CEO, Anand Rathi Wealth Management. Hi Feroze, thanks so much for joining in. Let me start by asking you, what's the kind of traction you've really seen among HNIs investing in this particular avenue?
See, over the last few years, HNI lending towards real estate sector has significantly gone up. Why? Because real estate sector first used to borrow from banks, and that was closed.
Right.
Then it started borrowing from private equity funds and venture capital funds. That also dried down, and that's when the real estate segment turned towards the HNI, seeking support because it's a business which requires a lot of capital as well to maintain their cash flow. So over the last couple of years, I think there has been a lot of traction and a lot of HNI money has gone in to the real estate sector,
right,
especially in the larger cities. Not the two-tier cities, but the larger metros like the Mumbai and Delhi, Bangalore.
Right.
These are the large three cities which have taken lion's share of HNI money towards the real estate sector.
Any estimates you can give us of what's the kind of money that's really gone in?
See, there are two formats to actually participate, and HNI participates in it directly buying the debenture of the real estate company or buys a fund which promises to buy 6-7 such debentures. So this latter portion of investing through a fund into real estate companies is a more structured format. So I can put some numbers around that. That's about 6,000 odd crores has been collected. And the other part, which is directly lending, is difficult to measure because it's not a structured industry. But I think that should be of equal quantums, if not more.
True. And take us through what are the kind of products, I mean, what's the kind of returns and how is this whole thing really structured?
See, if you look at buying a real estate NCD, the return ranges, pre-tax return ranges, let me be very categorically specific there, ranges between 18 to 22% or 17 to 22% has been the range of return pre-tax. But unfortunately, these actually give interest income, and HNI generally falls in the highest tax bracket from a marginal tax rate perspective. So he loses almost about 30% in taxation and ranges post-tax between 11 to 13%. Now that is if he buys the real estate debenture by himself. But if you buy through a fund, then what happens is there are other costs involved, management fee, profit share, that brings it down to almost post-tax, post-expense to almost about 10% odd.
Right.
So large portion of the extra return is getting eaten away because of taxation and costs if you go through a fund. But if you go directly, then there's only one element to take care of, that is tax.
Right, right. So I'm going to get to the specifics of the risks and what people should really watch out for. But before that, at a more broader level, how would you really compare the risk-reward trade-off for this kind of an investment?
See, risk-reward trade-off is very favorable before tax.
Okay.
For example, an investor's birthright is 9%, right? 9%, 8.5% post-tax in a debt fund over 3-year period.
Right.
Because of indexation he gets. Whatever excess return which comes, which is about 8-9%, that's a very lucrative extra return which a person is getting. But if he's losing 6% or 7% of the extra return to taxes, then you're actually taking all the risk and a large portion of the return is going towards taxes. So then it becomes a completely lopsided kind of a risk-reward ratio. Pre-tax, it's very good. If it's an NBFC or a company investing and it has business expenses which it can offset, then it becomes a very, very lucrative thing. But if an individual can't offset his expenses, then post-tax basis, of course, it's not a very attractive proposition because you get 9 plus 9, and the 9 out of which 6 or 7 is lost in taxation. So a large portion of the extra risk is gone away in taxation.
Right, right. So one of the points that that's important to note, I think, is that real estate mezzanine debt funds are not really covered under the FICCI Act. What are the implications of that?
See, what happens is FICCI Act as an instrument or was a mechanism introduced, I think, about 10 odd years back by RBI and giving the right to bankers to be able to recover money far more easily. So that act is not applicable because the HNI is not a bank. Okay, it is not, since it's not a financial organization, so what happens is he is expected to go through the other laws, like civil laws, to recover his money in case of a default.
Yeah.
And that brings a large risk, because your propensity to recover in case of default, because you have a collateral, if the collateral is subject to litigation, and if the litigation in our country can range between 6 to 8 years, then you're speaking about large opportunity costs. So FICCI Act is basically an act in which a bank recovers its money far more easily than it used to in the past. So that is not applicable, because the person, which is a HNI or a company, is not a bank, does not get the right to exercise FICCI Act.
Right. So for somebody who is looking at, lending to real estate builders and things like that, what are the areas that they should be aware about in terms of what are the financial ratios to look at? How should you really assess whether it's worth investing?
See, it's a very complex thingy, because it looks on the face of it, it looks very simple, because you're lending to somebody, he's promising you a return, he's given you collateral, real estate collateral. At the face of it, looks simpler. So let me lay down a few very, very important points, because the quantums of money an individual invests is not 2 lakhs, 4 lakhs, 5 lakhs. Correct. Generally, you meet people who have invested 50 lakhs, 75 lakhs. When you're dealing with lump sum amounts of those quantums, you have to be careful about 3-4 things. Let me put it across. The first one is to check whether you have collateral. And if you have collateral, is it an English mortgage? Right. Okay, there's a concept called English mortgage, where if I am lending to a real estate developer, and if he's giving me English mortgage, that means he's transferring the property to my name in the sub-registrar office, with a conditionality that once he repays my money, he will be able to revoke his power on the property. That is a very, very important attribute. If you have a real estate debenture with English mortgage, your risk come down to half, if not more. So English mortgage is the first thing you need to check. Okay. The second thing you need to check is that when you have an under construction property, you generally have an escrow account to make sure that if there's an under construction property which is being sold to somebody else and it is collateralized to you, there is a third party coming in. So he will keep making payments to the builder that needs to go into an escrow account. Is there an escrow mechanism? And if there is an escrow mechanism, who's the trustee to ensure that my interests will be protected? Because builder as a community is crash crunched. So it is the propensity to move one project's money to another, actually diversion of money is very, very prominent. So escrow accounts, trustee is the one thing which you have to check. Okay. Then if you move on and check further, then you need to look at what stage of construction is the collateral at. That's very, very important, because and approvals, of course. If the approvals are still not in place, and if somebody is raising money on a project, then it's basically you're funding somebody against land. So that's one thing. You have to see whether what stage of construction is the project in. And then you need to look at ratios, like you rightly pointed out, Apni. That's very, very important. See, the collateral is a backup plan. Your plan B cannot be the largest focus. Plan A, that the company will do well and repay, is your first source, right? So to find out the health of the company, just like you would evaluate any other company, looking at 3-4 ratios, return on equity, interest coverage ratio, debt to equity ratio, these ratios will tell you the strength of the balance sheet and the propensity of the business to repay rather than the collateral to repay. And as long as you get an answer that there's a 90% chance that the business will pay it and collateral is just my plan B, then you're good to go. Right.
The other part is in terms of the kind of fee structure that such kind of lending may have, or any profit sharing. What typically happens?
See, that's one very, very grey kind of a shade of this investment. We analyzed a few funds, and startlingly, 22%, one fund which has about 431 odd crores, again promoted by a really prominent banks division, where we said 22% is what the builder is paying the fund. The client, who's the investor, has ended up making post-tax post fee only 9.1%. Now that's a large dilution. You go from 9 to 22 and then you get back to 9. So what are the 3 types of fees you need to watch out for if you use a fund to participate? Is the management fee, an entry load, a profit share, and then you also have some administrative fees. So you have to be very cautious of what is the cumulative aggregation of these fees. If the cumulative aggregation of these fees exceeds 2.5%, then it's definitely not a very good bargain.
Right. So we've talked about a whole host of things to keep in mind, but as a wealth manager, what is your own assessment of these kind of investment avenues? Would you recommend it? And if so, what would when would you say that one should sort of go ahead and look at an investment like this?
See, at this stage, when this whole benefit has been reaped for the last 3-4 years, it's like who would have the hot potato in his hand at the end. So I think you're running at the last lap of this series. So if you're planning to invest now, I think the large risk-free money which was supposed to be made is made already. So now the risks have gone up multifold because the pile-up of inventory in these metros on real estate sector have shot up almost threefold over the last 3 years. So you investing 3 years back and now is very, very different. So I would say for the last 1 year at least, we have told HNI investors to stay away because the sector is going through a large transformation and regulatory transformation. Like recently, of course, there has been a real estate bill which will definitely change the shape the way the industry
is. Do you think the real estate bill will impact this kind of lending in any way?
See, what happens is all the deviations which the builder takes is when he is able to pay you 22%.
Right.
See, it doesn't meet the eye that if the risk-free rate in the country is 7.5, what kind of businesses can actually afford to pay 22%?
Right, exactly.
Unless they are taking some deviation. If the real estate bill comes, and as and when it comes, of course it's going to be some time, then the real estate developer is not able to take shortcuts to be able to generate this 22%. The business needs to make 30% to actually support a return on debt or obligation on debt at 22%. So I personally think you're at the last lap. So if you have some, you should try and mature them as they progress, but not start fresh, because 3 years from now the real estate sector the stress would be significantly more than it is today.
All right, Feroze, we leave it there. Thanks so much for joining in today. All right, time for another quick break. On the other side, we'll tell you how the new MCLR regime will impact your home loan rates. Stay tuned.